The Panic of 1907, How One Banker Saved America and Changed Money Forever. 1. The week the system broke. It began quietly, whispers on Wall Street, a failed stock gamble, a few bank runs. Then came October 1907. Within days, America stood on the edge of financial collapse. Banks locked their doors. Depositors crowded sidewalks, desperate to withdraw savings before the vaults went dry. The stock market plunged 50%. Credit evaporated. The entire industrial engine of the nation stopped breathing. And Washington? Paralyzed. There was no Federal Reserve. No deposit insurance. No government backstop. When panic struck, survival depended on trust, and trust was gone. Then one man stepped forward. Not a president. Not a lawmaker. A private banker. John Pierpont Morgan. At 70, he was already a legend, the iron banker who financed railroads, steel, and American industry. Now, the fate of the nation rested in his hands. Footnote. When a system has no safety net, power always falls to whoever still has cash and confidence. 2. The man who locked the doors. As panic consumed New York, Morgan gathered the country's leading financiers inside his Madison Avenue mansion. He locked the doors and delivered an ultimatum: no one leaves until a plan is made to save the system. Over 2 sleepless nights, Morgan personally examined ledgers by lamplight, deciding which banks would live and which would die. When the Knickerbocker Trust collapsed, the third largest in the city, the panic deepened. Trust companies were the unregulated Wild West of finance. Their failure spread fear nationwide. Morgan's solution was audacious. He organized a $25 million rescue fund, roughly $800 million today, personally underwriting the lifeline. His credibility alone calmed depositors. If Morgan said a bank was sound, it survived. If not, it vanished. When the New York Stock Exchange itself teetered on the brink of closure, he did it again, summoning trust executives and forcing them to pledge funds to keep the market open. It was one man commanding a national rescue from his library. Footnote. In a democracy, it was the private banker, not the president, who decided which banks lived and which died. 3. The moral shock. The panic passed. Confidence returned. America had been saved, but not by government or law, by Morgan's will. Newspapers hailed him as a hero. Others called him a tyrant. The country had learned a disturbing truth: its entire economy was held together by private trust. Congress responded with investigations. The Pujo Committee uncovered the money trust, a network of elite bankers controlling entire industries through interlocking directorates. J.P. Morgan, Rockefeller, and Kuhn Loeb sat at the center of this invisible empire. It was proof that democracy's markets were being managed by an unelected oligarchy. The same men who had caused the crisis were the ones who had saved it, and that was intolerable. Footnote. When the system depends on heroes, it's already broken. 4. The birth of the Federal Reserve. In 1910, under cover of secrecy, senators and bankers met on Jekyll Island to design a permanent solution. Their goal: to prevent another 1907 by creating a central bank, a lender of last resort. Ironically, the very men whose dominance had sparked outrage were now writing the reform. 3 years later, the Federal Reserve Act of 1913 became law. 12 regional banks were created to inject liquidity during crises. On paper, it was a balance between public oversight and private control. In reality, it formalized the same system: private influence guiding public policy. J.P. Morgan died that same year. The torch passed from a man to an institution. The Fed became the new Morgan: centralized, powerful, and indispensable. Footnote. The Panic of 1907 ended the era of private power, and replaced it with institutionalized power. 5. The pattern that never ended. The ghost of 1907 never left. Every financial crisis since has followed the same pattern. 1929, the Fed hesitated. Banks failed. Depression followed. 1987, the Fed intervened. Markets recovered. 2008, the Fed printed trillions. The system survived, barely. Each time, the logic was the same: when confidence breaks, act fast, act big, act at any cost. Each rescue prevented collapse but deepened dependency. Markets learned that risk would be socialized while profits remained private. That was Morgan's paradox: his success made failure survivable, and therefore inevitable. Footnote: every bailout plants the seed for the next crisis. 6. The legacy of control. Morgan never sought political power, yet he wielded more of it than any president. His rescue proved that money could govern as effectively as law, and that belief still shapes the modern world. Today, central banks play Morgan's role in every major economy: the Federal Reserve, the European Central Bank, the Bank of Japan. They stabilize markets with interest rates and liquidity. They manufacture confidence. They decide who gets saved. But the moral dilemma remains: who benefits when the system is saved, and who pays for its survival? The wealthy protect assets, the public absorbs inflation. Stability is purchased at the price of freedom. Footnote: the cost of order is control, and control never flows downward. 7. The lasting question. The Panic of 1907 was not just a financial event. It was a revelation that capitalism depends on faith, and faith depends on power. When trust vanishes, systems collapse, whether in 1907, 1929, or tomorrow. So what does that actually mean? It means that every crisis since has been a reenactment of that night in Morgan's library, a handful of men deciding the fate of millions. The names have changed, the rooms look different, but the question remains the same. Can a financial system built on confidence ever be truly stable? Footnote: every rescue buys time, but never permanence.